people often refer to as a 1031 exchange,
Mm-hmm.
which is you own a property, and as long as you buy a like property or greater than,
Mm-hmm.
you can sell it. Let's say you made $100,000 in appreciation. You can take that, no capital gains tax, and put it into another piece of real estate.
Okay.
You are deferring your taxes. But
Yeah.
that's honestly, man, like once I really started to understand uh, buying real estate through things such as cost segregation and bonus depreciation, those are things where you start to realize, holy crap, there's a lot with real estate that's a lot farther than 1031 exchange. I've never done a 1031 exchange.
Oh, okay.
However, but in my business, and I'm very blessed to have the income and business that I have now,
Mm-hmm.
and we've had for a few years, but through legal ways that the tax code is written by buying real estate. Last year I paid very, very minimal to zero in taxes, and based on my income bracket, it's pretty crazy.
Okay, so with those two strategies you just said, I don't
Yeah.
think I've ever heard of those before. So
Yes.
can you break down
Yes.
what does that look
I'll
like?
I'll do it as simple as possible. So these are IRS codes. So if you are looking, I would recommend talking to an accountant 100%
Mm-hmm.
because I'm not that. But the way that it works is, let's say, when you buy a piece of real estate, first off, there's one of the tax benefits of real estate is called depreciation.
Mm-hmm.
So what this means is, now you hear that and you think, well, I thought real estate appreciates. It
Right.
does. It does. Statistically, before COVID, it was 3.6% year over year
Right.
for a piece of real estate.
Now jumped up.
Yeah. After COVID, it was
Jumped up like crazy.
like crazy. Yep, the last 5 years, like 44%,
Oh my
45%.
God.
So, so your property appreciates, but there's parts of that property that don't. For example, that cabinet is not going to last forever. That
Yeah.
flooring is going to wear, right? That water heater is going to go out. So what
Mhm.
happens is when you buy a piece of rental, like buy a piece of real estate, specifically a home, multifamily, apartment buildings, right?
Mhm.
Things like that. You go in, and commercial, you can do this as well. But they do something what's called a cost segregation study. So the
Okay.
way that it works, just to keep it super simple, let's say you buy a house for 100 grand. That cost segregation study is done by an engineering firm, and they'll go in there and they'll look at all that stuff. How
Mhm.
much flooring do you have? How many cabinets? How much this? All the stuff that's going to depreciate, because
Yeah.
not all that stuff will last forever. The land doesn't count. The land is the IRS says that'll appreciate, right? The outside of the property, like brick and things like that, the
Yeah.
concrete, that stuff will appreciate. It's not going to go anywhere.
Mhm.
But the things inside will depreciate. So they take a study and they'll say, okay, $100,000 property, we believe roughly 50,000 of that can, through a cost segregation study, can be used for what's called bonus depreciation. Now, this is one of the ways that I really learned that this is really how people in real estate, like the rich, get richer. Because what happens is, let's say, for example, you have that cost segregation study. There's $50,000 worth of what they're going to call depreciating value. If you don't do that study, a simple, what's referred to as straight line depreciation, is that
Mhm.
$100,000, that house, the IRS says you can depreciate that over 27 and a half years. Okay.
Okay.
So you take 100 grand and divide that by 27 and a half,
Mhm.
you get that amount towards paying down your tax bill. Okay. Or I should say, taking that off of your taxable income.
Yeah.
So for easy note, like I'll pull up my calculator while we're doing it and give you an example. If you don't do one of these cost segregation studies, the way that it works, and I'll show you guys like an actual example, but you got 100 grand, divide that by 27 and a half years,
Mhm.
you can take 3,600. So let's say next year your income's $100,000. I could decrease my $100,000 income now to be taxable based on 96.
Right.
Okay.
Right.
But what a cost segregation study does is it says, okay, that property's 100 grand. And let's just say, I'm just going to keep this easy numbers. It's not exactly, but let's say roughly $50,000 of that is what's referred to as bonus depreciation,
Hmm.
which what means is instead of taking that over 27 and a half years,
Yeah.
you can take it in year one.
Oh.
So let's say my taxable income's $100,000 as an example. I buy a piece of property. I get a cost segregation study, and I find out I can actually end up, and let's say realistically for a $100,000 house, it's not going to be 50 grand, but let's just say it's 25,000. If
Mhm.
I have a $100,000 income and I just went from $100,000 to 75,
That's huge.
I need to buy more real estate to get to zero. So this is when they talk about Donald Trump not paying taxes and saying he won't show his tax returns.
Yeah.
It's because he does this at a massive scale.
Okay.
So people who own properties have to keep buying properties so that every single year
Yeah.
they don't pay taxes.
Right.
But they're doing it legally because and actually what happened in the most recent administration, Biden's administration, they started to take that down. So it went from you could take 100% in year one, and they started to decrease it to 80, then 60, then 40, and now we're at 40, and now Trump's back in, and they assume that it's going to go back to 100.
Wow.
But this is the way that people who buy real estate do it. Now, the only way that you can do that is actually if you are a licensed, or not a licensed, excuse me, if you are considered a real estate professional, and that's tax code, right? So what some people do is, let's say, a guy's an engineer, makes great money, he starts investing in real estate. Wife stays at home with the kids. Wife gets a real estate license. She's now technically a real estate professional. Or if you're not married and you're, same situation, guy's an engineer, makes good money, buys real estate, he goes and puts enough time into his real estate investing that he no longer, or that he now, based on IRS code, could be considered a real estate professional, and he can use that. Or, doesn't matter if you're a real estate professional, you can do that with short-term rental properties, Airbnbs.
Yeah.
So that's why
You do that with Airbnbs?
Yes, sir.
Do you?
I do. Yeah. So my wife and I have one Airbnb. So we have one Airbnb, 10 long-term rentals, and then I'm in the process of purchasing my first multi-tenant retail commercial property in Crown Point.